All right, so it's time for our fresh edition of Money Love. First of all, I want to thank you for all of the messages you dropped in the comment section of our previous session. I really enjoyed reading all of those messages. So many of you said that you're looking forward to information on mutual funds. Alka Shah, for example, said that she really wants more information on mutual funds. Well, that is what this episode is going to be about. We're going to talk about mutual funds. But before we go further, remember, this is a partnership. My team and I have partnered with a brand called Frio. Now, Frio is a brand new banking experience that you must check out. The idea with Frio is to help you control your money better and to help you make the most out of your money so you can do more with your money. So you can check out Frio to see what that new banking experience is like and test it out. We're talking about mutual funds this week, and there's a reason, because if we go through what we've talked about up till now, we talked about how you can save more money from your paycheck on a monthly basis, whether you're freelance or you're salaried. We also talked about, how you can take control of your money, especially if you're a woman, and how you can start investing. Now, remember where we left off last week? We talked about 3 different kinds of investments, right? So there's equity, which is investing in stocks and actually owning companies. There's debt, which is lending your money to people, which could be a bank, it could be the government, it could be a corporate. You lend your money for a fixed interest. And then there is commodities, where effectively you are buying an underlying commodity. It could be gold, it could be any of the other commodities that are traded on the exchanges. Today we're going to talk about mutual funds. Now, here's the thing that we have to remember, first of all. People would always ask you, do you want to do mutual funds or do you want to do fixed deposits? Now, that would suggest that people think that mutual funds is actually an asset class. Asset classes are equity, debt, and commodities. These are the 3 asset classes that exist. Mutual funds is actually a route to get to these asset classes. So if we chart it out like we did last time, what your goals are based on the actual term of your goal, which means that you're saving money for the next 10 years or you're saving money for the next 30 years, then you should ideally be putting your money in equity. If you're saving for something that's closer by, you should be putting your money in fixed income. Now, mutual funds is one way to do all of this, especially for those of us who are retail investors, which means we're not really traders and we don't sit all day in front of our computers tracking the stock market. Mutual funds is a good route to do that. The second reason why mutual funds are good for retail investors like you and me is because you can start very small. The minimum investment in a mutual fund is 500 rupees a month, which is a great place to start. You can start with as low as that much. Plus the fact that mutual funds allows you to invest on a monthly basis. So you don't have to wait until you have, say, 1 lakh rupees to get started. If you have 500 rupees to set aside every month, you can start on mutual funds and you can do something called an SIP, which is a systematic investment plan, which basically means it's like an EMI. You put money in, you just say that, okay, every month I'll put 500 rupees. And it just goes out of your account. And so most of the time we earn monthly, we spend monthly, we save monthly. It makes sense to also invest monthly, which is why mutual funds, the way they're structured, makes sense for us. The real decision is what kind of mutual fund do you want to buy? Are you going to equity? Are you going into debt? Are you going into commodities? But mutual funds can help you access all of these investments. Now, there are a couple of other advantages of using SIPs as well. Now, people confuse SIPs with maybe the premium that you pay on your insurance policy, where the fear is that if you happen to miss a payment, the whole thing will lapse and no longer function. That does not happen with a mutual fund. If you happen to miss a payment for whatever reason, the rest of it continues to stay invested and continues to move. If, for example, you can no longer pay this payment and you want to stop, all you have to do is issue a stop payment and it stops on its own. There's no penalty that you have to pay. There's no fine that you have to pay. The other advantage, in my opinion, of a mutual fund is, let's assume that you put 1,000 rupees in a mutual fund every month. So at the end of the year, you've now got 12,000 rupees. And at some point you feel the need that you need 3,000 rupees for something, you can pull out only 3,000 rupees and leave the rest in there. So you don't have to break your entire investment and take everything out. And I see that as a massive advantage to using mutual funds. So now let's take a look at how the mutual fund works at all. So fundamentally, if you consider retail investors and the fact that we don't have a lot of money to start off with, if you have 500 rupees a month to spare, you can't really buy gold with it. You certainly can't buy real estate. You can't go out and buy the stock of, say, Infosys, because no broker will take you on at 500 rupees a month. What a mutual fund does is that it allows us all to pool our money and give that pool of money to a fund manager who then will invest it in the stock market on our instructions, on our behalf. And the money that he makes is then divided among all of the people. So, what has happened is we've mutually put all of our money together, we've created a fund, we've got a fund manager to invest it. That's how a mutual fund fundamentally works. So, you can, of course, pool all your money together and say, we want you to invest this only in large cap stocks, or we want you to invest it only in mid cap stocks, or invest it only in small cap stocks, or we give you no restriction. Invest it in the stock market wherever you please. So these are all different kinds of mutual funds, and this is how they work. Where basically, the money is pooled and the fund manager is given an instruction of where this money needs to go. So you'll read a lot of this. So equity, debt, and commodities. So let's take a look at equity funds. So you'll have equity funds, then you have equity large cap, which is basically money that goes into the stock market that's going specifically into large cap stocks, equity mid cap, equity small cap. Equity diversified is basically no restriction. Put it in the stock market, that's the only instruction we're giving the fund manager. That gives him a little more elbow room actually to make changes and to actually decide where the fund manager, where he or she wants to actually put that money. Then you have sector specific, where you say, yes, I want this money in equity, but I want you to put it only in banking stocks. So then you'll have a banking sector fund. You'll have an infrastructure sector fund, or similarly like that, different sectors will break it up differently. On the debt side, so you have debt investment funds, where basically the fund manager will buy some government debt, buy some corporate debt, and do a mix of all of this and give you a certain return which will be slightly better than your fixed deposit. So those are how debt funds work, and the debt that he buys will be of different tenure. So they'll be very short, they'll be short term, and he will use a mix of that, or she will use a mix of that to be able to give you a good return. So that's how debt works. And then, of course, commodities will have an underlying commodity. So they'll either go out and buy gold, or they'll buy oil, or whatever commodity you have instructed that fund manager to buy. So fundamentally, theoretically, that's how mutual funds work. Now, in practice, you will hear of a term called an NAV, which is a net asset value. It sounds complicated, but it isn't. What it does basically is it turns the entire mutual fund into units, and every unit has a value. So for example, if the unit value today is 10 rupees and you invest 100 rupees, you will get 10 units in your credit. If tomorrow the unit value becomes 20 rupees per unit and you have invested 100 rupees, you will only get 5 units to your credit. So in order to be able to make that buying and selling and entry and exit for investors easier, there is a system called the net asset value. But it really isn't something that you should worry about too much. Effectively, remember what we talked about last week. You decide what your goal is. If you're investing for the next 10 years, you're definitely in equity, because that will beat inflation. It will give you a good rate over a long term. It will give you a better rate than fixed income. Now you have to decide, do you want to do large cap, small cap, mid cap? What do you want to do? I would say decide based on your risk appetite. Of course, mid and small cap tends to be of a higher risk. Large cap tends to be a little more stable. So for example, if you take the big companies, if you take an Infosys or a Reliance, they tend to have a certain predictable performance. Even when they do well, they do certainly that well. But when you take a small company that's growing very rapidly, it could turn into the next Infosys, in which case you'll make a lot of money, but it may not either. So the risk tends to be a lot higher. So that's how you divide it. And fundamentally, the thumb rule that I use is the longer you can stay invested in the market. If you have 30 years, then by all means take more risk, because you have the ability to withstand that risk. If you have 5 years or 7 years, lower the risk that you're going to take and go buy more predictable investments, which means large cap stocks mixed with fixed income investments. And there are also hybrid funds that will give you a mix of the two, which will do about 60% equity and 40% fixed income, so that you temper your risk down a little more. So, risk and reward is in all investments, but you really have to choose based on the time you have in the market. Now, a lot of people will ask, how does time you have in the market reduce risk? Because imagine if you were to, say, invest for the next 20 years for something really important like your retirement, and just when you're approaching year number 19 and you've invested so patiently for 20 years, the stock market crashes. What happens to your money? That's a very good point. Now, the understanding is this. Let's assume you have 20 years to invest. You will start from year 1 to year 10 in high risk investments. But as you approach your target, your actual tenure now has come down. Now you only have 5 more years, you have 4 more years, you have 3 more years. You'll start removing that money and moving it into fixed income, into fixed deposits where the risk comes down lower and lower. If you happen to be in the beginning of your investment, so you're in the first 5 years of a 20-year investment and the stock market comes down, you have the ability to wait it out, because as we have shown you, the stock market always comes back up after a certain point. So this down is temporary, and it's really about your ability to hold on and say, I can wait, I have time on my hands, which is why you should only invest in the stock market if you have time on your hands. If you're running out of that time, which means your goal is coming closer and closer, you should move your money out and put it into a recurring deposit or a fixed deposit or a fixed income mutual fund so that the risk comes down sharply. Now, what happens when you decide to sell your funds? Like I said, if you have, God willing, 30 lakh rupees, accumulated, or if you've been investing for 20 years, maybe you have 1 crore rupees. You don't have to break it and take it all out because it's not a fixed deposit. You can actually take out only as much as you need and let the rest of it continue to earn money. The longer you stay invested, as a thumb rule, the longer you stay invested, the better your returns will be, because remember, we talked about compounding. The couple of things you must remember about mutual funds when you use them, though. One is the tax treatment. There is short-term capital gains tax, which means that if you pull your money out in less than 1 year and you've made a profit, you will have to pay 15% tax on that profit. If you keep it for longer than 1 year and your return is less than 1 lakh rupees, your profit is less than 1 lakh rupees, then it's completely tax-free. If it's more than 1 lakh rupees, then there is a long-term capital gains tax of 10% as well on that. The other thing to remember is, like everything else, mutual funds are not free. There are charges that come onto a mutual fund. This includes the commission of the person who has sold you the fund, the agent, plus the fund manager, remember, who's doing all of the work and tracking the market for you. Now, on an average, mutual funds tend to charge about 2.5% of the net asset value, which is what they will take. 2.5% is what they will take as charges, but it tends to be a lot lower. So you can also buy the fund directly online from the company, in which case you've eliminated the agent and you save that money. The other thing you can do is buy a fund that has a lower fund management fee, because it's just mapping the Sensex. There's no intelligence being applied, so the fund management fee will be very, very low. These are called ETFs or index funds, which do exactly what the index is doing. It will give you the same return that the Sensex or the Nifty is giving you, for example. The rate of charges are lower, and so it doesn't come out of your return and you make slightly higher money. So I know that it's tempting to save that money and not use the agent, but I find that agents are useful because they sort of jump on your back a little bit and they'll be like, no, you have to. It makes us do more than rather than just leave the money in our bank account. So just to recap, let me put this in a nutshell, right? Retail investors who have day jobs and don't have the time and the energy to track the stock market on a daily basis. You don't have large amounts of money to buy commodities or to buy stocks, buy large stocks. We can use mutual funds. Mutual funds also give us a fund manager who manages the money for us. If you're using mutual funds, remember to understand how a mutual fund works, to get good advice, and to also take a look at the track record of that mutual fund to see how it is done over a 5-year period, to actually understand it. There are some great websites available on the internet that map Indian mutual funds and give them star ratings. So it'll give it a 3-star, a 4-star, a 5-star based on its on its performance over the last few years. You can use that to decide whether or not that is a good mutual fund. Try and stay invested for as long as you can. Use the SIP, put in $500 a month if you have to. It'll just make you confident, and you can keep increasing that money as you become more and more confident. All right, so I'm going to leave you here. Remember, read about mutual funds and understand them better. And if you have any questions about those funds, I'll be very happy to answer your questions for you. A quick reminder, this is a partnership with Frio, which is a brand new banking experience. The whole idea behind Frio, and we agree about this, is that if you can take better control of your money, you can do more with your money. Do check out Frio as well. Thank you so much for watching. Leave us your questions. I'll see you next week.